Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So right now you might be looking around and thinking the stock market is really overvalued, and you would not be wrong if that's what you were thinking right now because of this. In the last 3 months, this is what the S&P 500 looks like. You can see here the technology, communications, some of the consumer cyclicals are doing absolutely amazing. Just let's call it technology. Okay, so the tech companies out there are doing absolutely amazing. The banks are doing absolutely horrible because of the bank collapse and so on. And then when you look at this, it just kind of makes you feel, you know what, yeah, everything is going to the moon, there's no opportunities out there, I'm not going to buy anything. Now, if you're in that situation and you think, you know what, there's nothing else out there, you will be wrong, because if you look at these other sectors, okay, there are opportunities appearing in a lot of the other sectors. There's a lot of Sharia compliant companies are now coming back to their fair values and so on. So that's what I want to look at today. Look at 5 different companies that you could potentially add to your portfolio. Okay. And one other thing I want to mention is it's great to have technology companies when tech is doing really well. 2022, I bet you did not want to own any technology companies. But that's when I actually started buying the Cisco's. I started buying more of Broadcom. That's when I started buying ASML. Okay, why did I do that? Because I knew at some point these companies will start, doing well. Obviously, in the long run, these companies basically do well, right? So that's why I was buying at the time. And right now, are they overvalued? I don't think they're overvalued, but I'm up so much I wouldn't be adding to them anytime soon. Okay. So it's really important to have a diversified portfolio. What I mean by that is there are 11 sectors in the S&P 500. Don't just buy technology companies because they go into the moon and so on. Especially if you are new to investing, it's really important to have a diversified portfolio. So maybe divide your entire portfolio into equal chunk and then basically make sure you invest in equally every single month. Dollar cost average every single month and focus on the long run. Don't think about because they're doing really well, it doesn't mean they're gonna be doing well for the rest of this life. Look at in energy, for example. Energy stocks last year did absolutely amazing. Right now, they're actually kind of coming back down to where I might actually be adding soon. One of the energy stocks. I love those. I love Exxon and I love Chevron, possibly one of them. Okay. The other one that I actually do like is EOG. So there are companies out there that I'm looking at right now that have come down quite a bit in terms of oil side of it. Okay. Now, there are other sectors that are obviously healthcare and so on, consumer staples and so on. So let me show you my portfolio. This is what my portfolio looks like right now without Adobe. So this is dividend paying companies only. So if you include Adobe, probably right now about 30% of it is the technology companies, because I do have quite a bit and I've always had that before. Okay, I've always tried to cut it down, but I like the fact that this technology heavy because that's what I know. That's basically my expertise in a way, right? Industrials are really good. A lot of the companies in the industrials, I actually know the business models and know what they're doing, and they were quite cheap, so I'm buying it, and I'm buying more right now. Healthcare is another one. Basically, I don't know much about it, but it's actually been undervalued, quite a few stocks in there, so I've been buying here and there as well, like companies like the Medtronics and so on. Consumer staples, I haven't actually touched it in a while because they were very expensive, like companies like Procter & Gamble and so on. But I've been buying more Unilever. I think I've got now 100 shares. Materials, I haven't actually added to recently. Apart from, in fact, I've been adding to Rio Tinto. Financials, S&P Global, that's the only company that I own. Consumer discretionary, real estate is only 4%. I haven't got any utilities, energies, and communications. Okay, communication and utilities are very difficult to find Sharia compliant companies because a lot of them are in very much is so much debt. But energy, there's so many, and real estate, obviously, there's so many. So what you should be doing is, especially if you're starting right now, have a diversified portfolio. Don't basically concentrate just on technology companies because that can be dangerous, or oil companies, or one sector, if that, okay? If, for example, you're new and you're still learning, then basically invest in the ETFs, the halal ETFs, rather than just invest in individual stocks, because you might, while you learn about the whole thing, then invest in those companies, okay, in those ETFs rather than focus on whatever. Now, before I move on, I just want to mention that it will be absolutely amazing if you can join us on the Discord. Okay, I'm trying to build a private Discord access to basically like-minded brothers and sisters who hopefully we'll help each other, inshallah, in the long run. Then now there are a few people there. In fact, what I've realized actually is a lot of people have actually managed to sign up for one of the tiers and actually downloaded this spreadsheets and so on, but haven't bothered with the Discord. Okay, if you haven't joined the Discord and you've already access to it, just if you have a good Discord account, just join us, inshallah. Just even if for that 1 month, inshallah, while you have subscription, inshallah. Okay, that will help the channel, that will help me, that will help, obviously, inshallah, for all of us in the long run. Right, let's get started. And again, like I've always said to you guys, this is not financial advice. Okay, this is kind of giving you some information, then you can go away and do your own research. Right. The first company we're looking at is UPS. I'm sure you know what UPS is, and the company, what they do is 147 billion market caps, and it has wide economic moat. Right now, its price is over $170 per share right now. The dividend yield is actually going up because the price is coming down 3.78% right now, which is really good for this company. Latest increase was about basically 7%, give or take. 5-year growth rate of 13% and 51% payout ratio. They have increased this dividend for 13 years in a row, and their payouts is about $6.48. Now the safety is 69%, so anything above 61 we say is fine. 10% profit margin, return on equity about 60%, free cash flow of $7 billion. Total return in the last 10 years is about basically 10%. Okay, and then next year they're expecting the earnings to grow about 10%, 4% after that. So this is the type of business that grows their revenue about 4% to 10% every single year. So 4% is not actually bad right now, although there's a little bit of decline going on, right? 3% discounted right now, $177 per share is where the price should be. Now, in terms of the reason why UBS come down quite a bit recently, it was because of the guidelines. Okay, they guided lower in terms of the EPS. So they said the EPS expected full year revenue adjusted operating profit margins to be at the low end of the previously guided range. And for that reason, the stock actually went down quite a bit on that day. And since then, it hasn't actually recovered. Okay, and it has obviously went down with the overall market. But generally, the company is doing well. I mean, there's nothing wrong with the business side of things. So I want to show you, like, in terms of revenue. Okay, people will still be delivering, people still want to deliver and so on, but as you can see, there is a bit of a decline in terms of revenue, and that's the reason why the stock actually gone down quite a bit. And when we look at the EPS as well, it is actually heading the right direction. So the EPS is not as bad as obviously, but you can see the next one is actually down, and then after that it's going to bounce back. So for that reason, I'm actually comfortable holding this. Okay, I've had it for basically a few months now. I would absolutely love this company to be at least, let me quickly show you how many shares of this company. I own 25 shares right now. I'm down about 4%. Okay, my average is $174 per share, is right now 170. If it comes down to 165, that will be absolutely amazing. I can buy more of this company. Right now in the overall, okay, it's about I think it's about 4.7% of this portfolio right now, which is actually quite high for me. Okay, the next company we're looking is another one that I own. That's Union Pacific Corporations. These are railroad companies. This is another company that when the economy is doing really well and people are basically, shipping things left and right, this is the company that actually basically does all the transportation from A to B in the United States. Okay, 118 billion market cap. It has wide economic moat. Price is $193 per share right now. Dividend yield 2.7 almost, which is quite nice. Latest increase was 18%. 5-year growth rate by 15%. Look at that, how amazing that is. And only 47% payout ratio. They have increased this dividend for 16 years, and the payout is $5.20, right? 88% safety, profit margin 27%, return on equity is absolutely amazing. $5.4 billion of free cash flow right now. Total return in the last 10 years, we're looking at about 11%. Next year is about 9% growth, expecting then 8%, then 5% discounted right now. $203 per share is where the price should be right now. Again, I genuinely love this company. Okay, it's in the right industry, is the type of business people don't actually like and invest in, whatever, but for me it's perfect. It has a wide economic moat. It's a huge company. They're increasing that dividend, so they've increased it for 16 years. The payout is really good. The safety is actually good. Profit margin, return on equity from investor perspective is really good. They have excellent free cash flow, and they discounted right now. So what's there, you've got to buy this. Like, I'm not saying you, but I have to basically add to it. Okay, so just to be transparent again, 26 basically shares of this company that I have in my portfolio right now. $205 per share is where my basically thing is, and just down about just above just below 2% and 100, so 190. So I will be buying if it goes maybe below 190 again, and that's what I've been doing lately. I would love to own at least maybe 5-6% of this. In fact, it might be already, there we go, it's almost to 6%, 5.61% of my overall portfolio, and I don't mind buying another 4 shares to kind of round it up to 30 shares, inshallah. And as you can see here, year to date is about 7% down and 7% down for the last 6 months and so on. And the PE is very, very well, 17 right now, forward PE, which is actually quite low for this company. Looking at the revenue side of things, you can see it's from 24.8 24.7, so there's tiny bit of decline, but then it comes back again. Similar sort of a situation as UPS, and for that reason basically it's trading slightly lower. When you look at the analyst, actually Wall Street is the only bit that's saying is actually buy. The other two are saying it's hold right now. Just quickly going back to UPS, so this is UPS that we're looking at right now. You could see shares outstanding is actually declining, okay, as well as the total sales is actually increasing, which is basically what you want to see. So the company, not only are they paying new dividends, they're buying back their own shares, which is absolutely amazing. Again, similar sort of situation when it comes to Union Pacific. Okay, as you can see here, if I can go back here, you can see the shares are declining every single year, and this is beautiful to see from 2013 where it was to where it is right now. That's absolutely amazing, and the total sales are also heading the right direction. So for a bit of cyclical because of the nature of this business, but as you can see, it's heading the right direction, which is really good. Right, the next company is Thermo Fisher Scientific, and this is again another company in the healthcare side of things. 201 billion market cap. It has wide economic moat. The price is $522 per share. Dividend is very, very low. Okay, but the latest increase was 6% for the 5-year growth rate, about 17%. The payout ratio only 15%, and they've increased this for 5 years in a row. $1.40 is what you get for every share of this company that you own. Safety is perfect. Profit margin, return on equity are all good. $5.6 billion of free cash flow. Total return in the last 10 years almost to 20%, and the next year about 12% in terms of the growth, in terms of the EPS side of things, and then almost a 9% after that. So it's discounted right now about 13%. $590 per share is where the price should be. Right, so going over to Seeking Alpha, we're looking at the, if you scroll down, looking at the EP, basically PE, it looks a little bit expensive. Forward PE of about 22, but this company has been trading around that for quite some time now anyway. So year to date is about 5-6% down, and when you look at the revenue side of it, okay, this is one of the ones from $5.44 billion to $45 billion. So it is definitely heading the right direction. There's no decline in the business side of things. In terms of EPS, earnings per share, as you can see, it's also heading the right directions from 23.0 to 23.7, basically in terms of EPS. And as you can see, Wall Street is the only one that is saying it's actually buy. And when we look at their one of the things that we're looking for, shares outstanding, it has increased a little bit before, but now it's actually coming back. They're buying back their own shares, and then total sales is heading the right direction, which is absolutely amazing to see. Right, we have 2 more companies, and then I'm going to show you from Sharia compliant side of things. This one is Air Product and Chemicals. Another company that I have in my portfolio is basically has a market cap of $60 billion. So it's not a huge company, but it is actually one of the nicest when it comes to the companies out there. Is almost every company that manufactures anything uses their products basically. It has a narrow economic moat. $273 per share is where the price is at right now. Dividend yield of 2.5, which is really nice. The 5-year growth rate of 11%, and the latest increase was 8%, which is really nice. Payout is about 61, slightly high. Dividend streak is of 40 years of paying that dividend, so they are dividend aristocrat. And then annual payout, you get $7. Safety 95%, so there's no issues there. Profit margin and return on equity are really good. Free cash flow 67 million, so it's not a lot. I wanted this to start increasing. I keep saying this, but I want to see this in the billions. Okay, Total return in the last year, basically in the last 10 years, about 13%. Next year, the earnings are expected to grow about 10%, then 9%, 16% right now discounted. $319 per share is where the price should be. So looking at total, basically shares outstanding, as you can see, it hasn't actually changed much. So it has increased a bit, but then it basically stayed the same in the last 3 years. So I'd rather the company actually use that money to reinvest it in the business. And when the stock price maybe becomes way cheaper, then they can buy their own shares. And again, the fact that they don't have a lot of cash right now, I don't actually mind that, okay? But the PE right now is basically based on PE, it actually looks expensive. It's about 24 forward PE. But according to Seeking Alpha and Wall Street, both of them are saying it is a buy right now. In terms of revenue growth next year, basically they're expecting this company to grow fast, which is really nice to see. Okay, I've had this company in my portfolio for a long time, so you can see the EPS is also growing. Now, just to be transparent again to show you, okay, I've got 15 shares. I've had them for a long time. I'm up about 13%. My average is $268 per share. Right now it's $273. So what am I going to do? I'm not going to touch it. I'm not going to add it anytime soon. I'm just going to leave it. Then the next one is the Estee Lauder. This is one of the companies that owns every single makeup brand out there. Almost a $70 billion market cap. It has wide economic moat. $194 per share is where the price is at. Dividend yields 1.36%. Latest increase was 10%. 5-year growth rate of 12%, which is really good. 66% payout ratio, and the difference of basically increasing that dividend for just 2 years. The annual payout is $2.64, safety 70%, profit margin almost 7%, and the return on equity 19%. They have $1 billion in the bank right now, 11% in terms of the last total return in the last 10 years. Next year, for whatever reason, they're expecting the earnings to grow by 60%. In fact, I'm going to double check that in a second with Seeking Alpha and see what they're saying. Growth estimate for the next 5 years is also 6%, 30% discounted right now. $253 per share is where the price is at. Final thing I want to show you before I basically move on to Seeking Alpha is from Sharia compliance side of things. All of these companies, according to Zoya, are actually Sharia compliant, so you can pause the video and have a look at that so far. Looking at the PE side of things, it seems very, very expensive. According to Wall Street, as usual, they're saying it's a buy. Yahoo basically Seeking Alpha is actually saying it's about 2.66. So that means it's actually hold for now, right now. But as you can see here, the price 23% down from basically where it was at the beginning of the year, and 6 months was about 10%. So it has declined quite a bit in the last basically 4 or 5 months, right? In terms of revenue, there is a reason why. So they're expecting the earnings to decline about $2 billion, just less than $2 billion in the next basically fiscal year. So we will see what happens. EPS is they're also expecting to decline. I'm not sure what's going on. Maybe there is a decline there. So if you're interested in the company, you're gonna have to read the basically the current earnings per share, basically not earnings per share, reports that they've recently released, okay, just to have a look at what the company has said in terms of growth side of it, what they said is going to happen in the next maybe 5-6 months. So the final thing I want to show you is shares outstanding, and as you can see, they head in the right direction, so they're going down, and total sales is heading the right direction, but there is an expected bit of a decline basically this year. There you have it. Okay, there are 5 different companies. All of them are right now seem discounted. If you're looking for stocks out there that are discounted, remember, as a value investor, you don't want to overpay. And some of these companies you've seen based on PE, they might be too expensive. But obviously, in terms of, in fact, I wanted to check one more thing for this company. Let's go to earnings, because I want to see the earnings estimate, because I said that we will check, right? So yeah, they're a bit of a decline, and then it's going to grow. Okay, so that's probably why 56, 33%, 20. So the first 3, if we take 56%, 58% growth, 33% growth for the basically next 2024 and 2025, that's probably why the average is very high. Okay, from 17 billion to 19 to 20 billion to 22 billion. So that's decent. Okay, that's really good, and that's probably why it's trading in higher multiples. There you have it. So if you're looking for discounted companies, there you got 5 different companies. As usual, I'm not a financial advisor, but I'm just giving you some ideas to look at, some research to do, obviously. If you are new to the market, you might be just to look at these type of EPF, basically ETFs, and buy those rather than buying the individual stocks, because individual stocks are very, very risky. Have a wonderful day. Assalamu Alaikum.